everybody, Jeff Rivett here, Portfolio Manager with Creed Capital Management at National Bank Financial, coming to you from our White Rock office today. Hope everyone's having a wonderful start to spring, and just wanted to give an update on the markets here for mid-April. Also with regards to tax season, I know everyone's been busy. Our team's certainly been very busy in trying to respond to requests for documents. If you haven't started yet, if you have any questions on anything, do please reach out to our team members. We'll be happy to get you set up with the documents you needed. Also want to introduce a new team member. And I've included in this email a bio on Philip Mack. Philip is someone that both Brett and I have known for probably 8 years now. He was working with a different firm in the financial industry. Just a really smart guy who we're really happy to have aboard to come help us in an associate role. And please, if you get a chance to talk to Phil, make him feel welcome. He's probably going to be calling around and introducing himself as well in the weeks to come. So yeah, welcome Phil, and certainly you can read his bio below. Also, just wanted to congratulate Charlotte Torrey. Charlie announced yesterday that she passed her final CFA exam, which is a huge monument for portfolio management. So just wanted to say congrats to Charlie as well, and if anyone watches this video, certainly send her your regards as well. So on the markets, the month of March was good. It was as good as February was bad, meaning that we're basically back to where we were at the end of January. And you'll recall that January was an extremely good month, one of the best Januaries we ever had. So we're back in the position, where in our model portfolios, we're up about 5% on the year, which is a great start. Keep that up for 8 more months. That'll be 20% for the year. So we'll see. That's probably not going to happen, but one can hope. The major shift in March was that while there was bad news with regards to the bank defaults in the U.S., bad news sometimes in the financial world is good news. And in the case of interest rates, having banks fail because rates were too high is causing the Federal Reserve and central banks across the world to maybe slow down and pause and rethink just how fast they want to be raising rates. And of course, rates going up and interest rates going up are a headwind to the economy, and rates staying the same or potentially dropping are seen as a big plus. So seeing that there was that sort of trouble in the U.S., seeing that rates might be coming down again now, or seemingly are on their way down, was a huge lift. So we saw bond prices come up. We saw U.S. equities also perform very well in our model portfolio, especially. Our U.S. names have outperformed the U.S. market. Internationally, actually, the developed world outside of North America has done better than North America. The U.S. has done better than Canada this year, but Europe has done really well in recovery, and some of the names, especially L'Oreal that we own, has done extremely well. The other nice bright light in the portfolios has been gold. Gold is basically at its all-time high right now. It's had a really strong start to the year. For those of you who know me, I'm a big gold fan, and thankful that we have both exposure to gold through companies and also through the metal itself in our models, and that's been a big plus for us this year too. I guess the sort of where we are now, it's been 1 month up, 1 month down, it seems, for the last 6 months now. So where we find ourselves now is sort of staring down the lens of recession. And we talked about recession, it seems like for a year now. I've said before that the indicators that economists look at to determine if we're going to have a recession, they've all been pointing at recession for quite some time. Yet sometimes when something is so expected, the opposite happens. We don't think that's the case. We think we will have a recession. But as I've said before, markets tend to perform worst leading up to a recession, and in recessions themselves, on average, the market is actually positive because it's seen as sort of that bottom, and the future is near. There's some signs that things could be slowing in the economy. With this banking crisis that happened in the U.S. In Canada, certainly our banks are in a much stronger position. However, it could cause some second guessing as far as lending goes, both in Canada and the U.S. So we could see banks sort of tighten up on capital that they're willing to give out, and that again will create a bit of a headwind in the economy, and we could start to see a bit of a slowdown. Now, recessions come in all different shapes and sizes. I've said before that I expect that if we do have a recession, it'll be a fairly small one because it's sort of it was created by what we had was an overheated market, and recession is really the answer to that. So we don't continue to have runaway inflation. The nice thing again is that inflation's coming down. Looking at the report last week, the numbers continue to show that we are seeing sort of a gradual deceleration in inflation. Some areas are still, employment and wages in the hospitality sector. There's areas that are still going up, but areas like used vehicles, which I hear stories from people about the prices of used cars. We saw an 11% decline last month in areas like that. So the craziness coming out of COVID, when money was kind of sloshing around everywhere and people were out spending it, seems to be dying down. We're seeing an end to inflation. Hopefully we'll see interest rates start to come down at the same time that a recession starts to build, and we'll start that next leg up in our next growth cycle. Portfolio wise, with interest rates coming down, that is a positive both for equities but also potentially for fixed income. I talked about bonds last month as an area that's quite attractive. Interest rates on government bonds are not quite as high as they were last month because bonds did rally in March, but we're still able to get sort of 3.5% or so on longer term government bonds. And again, these are bonds that fell 12-15% last year, so there's some upside to see these come back as rates come back down. So we expect that bonds over the next 3 years could return 6-7% with interest and with rates coming down and seeing the capital prices increase. Overall, positioning wise, the U.S. has outperformed Canada so far this year, but we don't expect that to continue. We expect that Canada will certainly catch up. A lot of positives in Canada. I think the resource sector, especially in an inflationary world, is very strong. Seeing gold prices and material prices up was very strong for Canada. Seeing energy prices potentially increasing as we've seen the last few weeks, very positive for Canada. So portfolio-wise, we have positioned much more now in Canada than we have traditionally. I would say the last few years we've been more overweight in the U.S. and we've switched that and we have more in Canada now than we do in the States. The other area that's interesting, again, with those bonds, with that fixed income, that sort of safe area of the market, we have seen a rally. So the opportunity that we took advantage of in December, January, February, and March may not be there as much anymore. But the preferred share market looks really attractive. We're seeing preferred shares with dividend rates of 6, sometimes 7%, and again that's a pretty good offer. That space of the market, because of the sort of potentially increased credit risk, because it's not as safe certainly as government bonds, but it's still that fixed income, that sort of non-equity area of the market where income can be earned. We do see that as bonds have rallied back and as we've seen other areas of the fixed income market back, preferred shares do seem like the area that's left behind. So We're looking to add to those in the portfolios with some of the cash holdings that we have, and hopefully get those 6-7% dividends coming out. So that's about it for me. Hope everyone has a great April, and I'll talk to you again next month. Thanks a lot. Bye.